Greetings class and welcome back. In this video I'm going to talk about month-end procedures. I'm in the instructions booklet here, and we want to start with Jim Adams, who is going to post all of the column totals in the special purpose journals. The column totals are in the special purpose journals where you have a column that just posts to sales at the end of the month, or maybe accounts receivable at the end of the month. You're just going to post that total into the general ledger for those particular accounts and reference whatever journal it's coming from. Then you want to go through the other column and post all of those other transactions to whatever appropriate general ledger account they go to, and make sure all of those are posted and that you put the appropriate check mark next to each item. So all of the others in these journals should be posted. So we're talking about the sales journal, we're talking about the purchases journal, we're talking about the cash receipts, and we're talking about cash disbursements journals, and then we have a payroll, of course. So in this particular month-end procedure, Jim Adams is going to go through all of these, posting these amounts into the GL. That's what you're supposed to do. And then look at any column that says other to make sure that the unique accounts are also entered. The second procedure is that Ray Kramer is going to prepare a bank reconciliation. And you have all the forms for this in the case that you need. The first thing is you've got a bank reconciliation form right here. You also have a bank statement. I don't have it open right now, but it's right here. So the bank statement is the December bank statement that came in. And we're going to look at that, and we're going to compare that to the list of transactions that cleared. So document 25 is the list of transactions that cleared. So we want to compare that with what's on the bank statement so that we identify any missing transactions. And then also compare that with what checks we've written this month to identify any outstanding checks. So as you may recall, basically what we're going to do with the bank reconciliation, we're going to start with a bank balance. Do this. Oh, that's why. It's very small. So we're going to start with a bank balance, whatever it is, according to the statement. So this is the statement amount. And we're going to have the book balance over here, and that's based on whatever is in the cash account that we have in our books. So this is based on the GL. For the bank statement, we want to add any deposits in transit, which means these are deposits that we know we made, but they're not showing up on the statement. So we have the deposits in transit that we're adding, and we're going to deduct outstanding checks. The outstanding checks we're going to find because we're going to compare our checks that we wrote during December with the list of cleared items, and so any that didn't clear are outstanding. So we want to add deposits in transit, subtract outstanding checks, and then we get an adjusted bank balance, okay? So basically with the bank balance, the only thing that we're going to adjust are for these transactions we know we did, but the bank doesn't have those in the statement. Over here on the book side of things, we're basically going to start with the book balance, which we have right here. if we have any deposits that we didn't have recorded, so the bank collects something for us, so there's a deposit in the statement but not in our book, we're going to add it in here. So if it's in the statement but not in the book, or not in the books, we want to add it in. Okay, if we have any cases where we've had a check come back from the bank as not sufficient funds, we want to take that out of cash. So if we have an NSF check, we're going to deduct it from cash. And then we're going to deduct any bank fees that they may charge us. So if we have a bank fee for the month, we're going to deduct that out, and then we'll wind up with an adjusted book balance. So if we get into this, we're going to have, we should have, the adjusted book and the adjusted bank balance should agree to each other. Now that's just the procedure. I'm not giving you any numbers or anything. This is how you would go about it. And you're going to use this particular form, that's the bank reconciliation right here. Instead of doing it manually like I did, you're going to have a bank going to update these beginning balances as the unadjusted balance, adding deposits in transit, subtracting outstanding checks, and that's only going to be for the bank statement. Then, if we have adjustments, which will be for things like bank fees, NSF checks, that's only going to be for the book balance or any deposit we didn't know about. Anyway, in the end, the bank statement balance and the GL balance should agree with each other. So that is the bank reconciliation. And when you finish this, the bank reconciliation, when you're signing off on it, it will be Ray Kramer's responsibility. So we have that part. So we do that procedure with the reconciliation. And you follow these 5 steps here. And then Jim Adams calculates and records unemployment taxes paid by employers and Warren's portion of the FICA. So when you go to the FICA, you can get that amount from the payroll journal or subsidiary ledger. Anyway, you can get it from the payroll transactions. Let's go back and look at that. I need to show you that. In the payroll transactions, we're going to go back here to the journals. So you have the payroll journal, and then in this journal, you're going to have a column that's Social Security, and you're going to have a column that is Medicare. So you want to total both Social Security and Medicare together for FICA. Remember? So our FICA number is going to be the total of Social Security and Medicare. And so you want that total for December, and based on the transactions you've been doing, you should have that. Now, this is a calculation in the payroll journal of what the employees are going to pay. But in this particular case, you're calculating what the employer is going to pay. Remember, the employee pays, but the employer matches. So this is the employer portion. So we're going to basically take whatever we have in the payroll journal and add it in this transaction. This transaction will be in the general journal, and it will be recording the FICA taxes payable that we have for Medicare and Social Security. We're also going to record SUTA tax payable. Now remember, in this case, the SUDA is only going to apply to employees who have salaries of $7,000 or less. And at this time, the only person that's going to have this is Nancy Ford. So we look at Nancy Ford's year-to-date salary, and it will be less than $7,000. So we take whatever that number is times this 0.0, or no, wait a minute. Let me do this over. That was getting all muddled. So we take the 7,000 times the 3.55%, and that gives us the SUDA payable. And then we take this, whatever the amount is, times 0.6%, and that gives us FUTA payable. The total of all these payables is going to be employer payroll taxes, all right? So when we get to the employer payroll taxes, basically that's going to be in the GL, that's going to be the debit. So we have payroll tax, and then we're going to identify each individual tax as a payable. So FUTA, SUDA, and FICA. All right. So that really is that one. Ray Kramer is going to approve all the monthly journal entries and put his initials in those or next to those, and then Jim Adams is going to post transactions from the general journal to the general ledger. So basically you're updating the general ledger. So updating the GL based on whatever is in these journals. And you're going to put a check mark in the journal where you post reference from that, posting from the general journal to the ledger. Nancy Ford will check the subsidiary accounts and make sure that they agree. So you have the subsidiary accounts receivable. They have to agree with the control account accounts receivable. And the same would be true for accounts payable and employee earnings and fixed assets. So all of these subsidiary ledgers are going to be compared to the control accounts. All right. Make sure that all those subsidiary transactions have been recorded, and that's what Nancy Ford does. And then the last thing here is that Jim Adams is going to prepare a monthly statement, and I believe you're going to prepare a statement for one customer. I think it's, I thought it was Eastern Wisconsin or something like that. Anyway, that's it for the month-end procedures, okay? So now what I want to do is talk about the year-end procedures. With the year-end procedures, let me go back to this. We're going to have the review of the general ledger to make sure all entries have been posted and that debits and credits are equal. Check figures, look at those. And then you're going to prepare an unadjusted trial balance. That basically is transferring the numbers from the GL to the year-end worksheet. Okay, so the year-end worksheet, basically, you're going to put these unadjusted GL numbers into that. Make sure you get that in there. Then you're going to do year-end adjusting entries. So here there are a couple of things I need to tell you about this. Number one, with depreciation expense, they're going to calculate it once a year at the end of the year. And the depreciation method is going to be straight line. And they're going to use a half-year convention, which means when we have an asset purchase in the first year, we're not going to have an entire year of depreciation. Instead of having a full year, we're going to have whatever the depreciation calculation is, and we're going to take that times 6 months out of 12, or 1/2. So we're going to use a 6 months depreciation standard for this. We're going to calculate 6 months in the year of acquisition, and 6 months in the year of disposal. So you have a half a year to begin with, a half a year to end with, and then every other year. So like year 2, you're going to have a full year of depreciation, and you're not going to weight that by 6/12, 1/2, or whatever. So in the first, when we say we're using, what would we say, a half-year convention, basically what that means is we're not going to count exactly from the date of acquisition. So if we bought an asset in December, we're just going to throw in 6 months of use for that in the first year. As long as you're applying this consistently, there's no harm in that. So we don't really care about when the assets went into service. We're just going to use the half-year convention in the year of acquisition and disposal. Then we're going to calculate interest on loans that's due. We're going to accrue the interest payable. So we're going to have principal times rate times time. And again, the time is going to be based on a 365-day year. Now, normally we would use a 360-day year, which is a banker's rule, but not in this case. So we're going to take the principal times the interest rate times the time. And we signed a note in December, so we're going to count the days between the date we signed the note and the date when the year, or the end of the year, and that's what we're going to accrue here. Bad debt expense is estimated once a year, and this is based on net sales. So basically what you're going to do is you're going to compute net sales by taking sales minus sales discount minus sales returns and allowances. And basically at that point you have net sales. So remember, if we're using this method, we're just taking the percentage they give us times net sales, and our adjustment is, it's not going to matter what's in the allowance account. If we were doing an aging, we would look at what's in the, basically whatever is in the allowance account, and decide, okay, based on our aging, this is what we should have. What do we have in the allowance account? And we take the difference. Here we don't care. So if we go back to this transaction list for bad debt expense, we're going to see, I didn't mean to do that. Oh, there it is. We're going to see that we're going to calculate the bad debt expense as 0.5% of net sales. So we're going to take 0.005 times whatever is in net sales. So we have 0.0005. Is that right? I may be putting one too many zeros in there. Okay. There it is. 0.00. Yeah, I put one too many zeros in there. It shouldn't be 3 zeros. It should only be 2. So 0.005. Whatever that number is, then the journal entry, the adjusting journal entry, will be a debit to bad debt expense and a credit to allowance. The allowance for doubtful accounts. All right. Ending inventory. This is the one that concerns me the most with this project, simply because when we look at the year-end inventory, we're dealing with a periodic inventory, and this is different from what we've done in class before. In most of our classes, we work with a with a perpetual inventory system, but in this case we have a periodic system. So let's go back to the project, and I want to look at the documents again. Okay, right here. Let's go back. I'll close this. Oh, I didn't mean to do that. Okay, here we are. This is what I wanted. So when we come back here, one of the things I want to look at here is the year-end worksheet, so I can show you kind of what we're looking at. Now, this is going to be, in your case, the numbers are not going to be exactly the same, but you're going to have, this is the 2021 post-closing trial balance, and over here you're going to have the unadjusted trial balance that you're putting in. And this is going to be based on the GL numbers you have to date, okay? So basically what that means is you're going to have an inventory number as a debit here. And what I want to point out to you is, with the inventory adjustment, we're trying to calculate the cost of goods sold. So when we do that, using a periodic method, we take the beginning inventory, whatever that is, and we're going to add purchases. We're going to deduct purchase returns and allowances and purchase discounts. We're going to add freight in, and so then basically what we're doing here is we're going to take beginning inventory, which will be over here, whatever that number is, plus net purchases, which will be here, and that's going to equal goods available for sale. And then we're going, so we take the beginning inventory plus purchases is goods available for sale, and then we subtract out the ending inventory. So, and I'm sorry, I shouldn't have put that there. Well, anyway. So anyway, we have this number for ending inventory. And when we subtract that from goods available, we get cost of goods sold. So the point here being, the way we're going to do that with this case and this transaction is we're going to consider all of these accounts in an adjustment, in an adjusting entry. So first, I want to go over here to the transaction list. No, I'm sorry, that's not it. Here it is. So look at this ending inventory. It says a physical inventory was taken on 1/1/23 before the business began for the year. Merchandise on hand cost 202,168. So here's what we're going to do. We want to, let me go back to this blank document. So in the previous year, or in our unadjusted trial balance, we have an amount for inventory. I don't know what that is right now, but I'm thinking it's somewhere around 101,000 something. And then when we look at this transaction list, it tells us that that should be 201 or 202,168. So we go back here, and so we have a 201 or 202,168. So basically, we're going to plug the adjustment here. So we're going to increase our inventory account by, in this case, I don't know if this is exactly the number you're going to deal with, but this is an example. 101,168. Okay, so that's one part of this, all right? And then, in order to account for these other components in the calculation of cost of goods sold, we're going to zero out the purchases and purchase discounts, purchase returns, and freight in. So we've dealt with here beginning and ending inventory, okay? This is ending inventory. This is beginning inventory. Now, what we want to do in the general ledger, well, let me list these out first. So we're going to do purchases. We're going to do purchase returns. We're going to do purchase discounts. And we're going to do freight in. Okay, so what we're going to do is we're going to go to the year-end unadjusted trial balance, and whatever number is in purchases is normally a debit. Whatever balance is in purchases, we're going to post as a credit. Whatever balance is in purchase returns and allowances, we're going to post as a debit because purchase returns are a credit, and the same thing for purchase discounts. And then freight in is normally a debit, so we're going to come over here and credit that. So here's, and basically what I'm telling you is you're going to have to calculate this ahead, and then when you get ready to do the adjusting journal entry, it will look like this. You're going to do inventory, and whatever that adjustment is, it's a debit. So you're going to have, in this case, this 101,168, assuming that that's correct. The next thing you want to do, you want to debit everything first, put all the debits first. So we're going to put purchase returns and discounts. So purchase returns and allowances, we're going to debit it so we zero it out. Okay, whatever balance is there, it becomes a debit. Purchase discount, whatever balance is there, it becomes a debit. Okay, and then we're going to record purchases as a credit. And we're going to record freight in as a credit. And last of all, but certainly not least, we're going to debit cost of goods sold. And it will be the difference between all of these. In other words, what you're really doing is you're going to take this beginning inventory number up here, add all these into it, add and subtract, and you get this amount, and you're going to subtract out the ending inventory. Well, we're not really going to do it this way, but we are doing that in an indirect way, and we come up with whatever the cost of goods sold is. So the cost of goods sold in this case is going to be a calculated number. It's not going to be based on an account. We don't have a cost of goods sold account in here because we're doing periodic inventory. So once again, remember the periodic system, and we're going to do an inventory calculation of cost of goods sold. We start with beginning inventory, add net purchases, subtract ending inventory, we get cost of goods sold. Another way to phrase that, we're going to close out purchases. We're going to adjust inventory to the amount we need for ending inventory. We're going to close out purchase returns, purchase discounts, purchases, and freight in. Whatever the difference is between all of these numbers, that debit will be in here for cost of goods sold. So anyway, I hope this helps you with the year-end procedures. I thought I had this already recorded, and my apologies, but I did not. So be sure to watch this and make the adjustments as needed. Take care. Have a great day.